Hello and welcome back to the channel. Here is now a new chapter on the contents of the OECD Model Convention and comparable other double taxation treaties. And we are going to deal now with the concrete rules, and the beginning shall be how we treat the gain from selling different assets. So, when it comes to the articles on how the income is distributed between the two states in question, we usually rely on the OECD Model Convention. And the OECD Model Convention that distinguishes between two different kinds of income, or two different kinds of events, to be more precise. The first one is gains from the alienation, so the selling of assets. That is Article 13. And there is the other alternative, that's current income from using these assets or from doing some other activities. That can be found in all other articles covering or contained in Article 6 to 21 of the OECD Model Convention. So gains from selling and current income are two different cases that has to be held apart by you. The reason for that is that originally, 100 or 150 years ago, one saw a huge difference between the single event of selling something and the ever and ever repeating event of income coming from an activity or using a house and collecting rent. There is a rather narrow, old understanding of income, which defined income only as something which regularly flows from a source or activity, whereas a gain is regarded as a single-time event, which cannot be equalized or identified, labeled income as all the other things. That's an old distinction, and it still is relevant in several Anglo-Saxon countries, or perhaps even more countries. For example, in England, there is still the distinction that regularly flowing income is taxed by income tax, whereas the gains have an extra tax, the capital gains tax. And so, in order to make clear that the rules of the double taxation treaties also are relevant not only for regular income but also for gains, this is clarified by having an extra article, Article 13, for gains. So, economically, there is a problem behind such a distinction, because selling an asset and keeping it and obtaining or collecting the current income from its use in all the future are economically somewhat equivalent, because the price which a rational buyer is willing to buy for an asset is nothing else than the discounted cash flow of all future cash flow from that asset. So the price is nothing else than collecting all the future regular income which you can obtain from that asset at once, with a discount for the difference in time. But economically, the discounted cash flow of, or the present value of all the future income, and the present value of the gain, which you can, or the price, sorry, is the same. So here we have two kinds of, or two different things which economically basically are the same: selling and using. So taxation usually should not treat these two equivalent behaviors differently. It should treat them alike, if one doesn't want to give the taxpayers a hidden choice between two ways how you can be taxed differently. You know, if as a taxpayer you have a choice, you will always try to opt for the cheaper version. And that means that a good legislation should always avoid such economically equivalent choices. Well, so if we look to the rules in Article 13, one of the criterion to form an opinion on if they are good or bad should be if they lead to an equivalent outcome between selling and current use, current income. Okay, so let's now have a short overview about the rules on selling. The general rule comes at the end here. It's Article 13, paragraph 5 of the OECD Model Convention that says all gains from the alienation of any property can only be taxed in the country of residence of the taxpayer if there has been no special rule mentioned before. So in the first 4 paragraphs there are some special rules. If none of them applies, everything which you sell can only become taxable in your country of residence. Now, the few special rules which take prevalence over the general rule are first, selling real estate, so a piece of land or a building mostly, are taxed usually where the building and the piece of land are located. Article 13.2, if you sell property of a permanent establishment, well, if it's immovable property, then you have already paragraph 1 as a special rule. So what remains to become regulated is Article 13.2, the movable property, which belongs to a PE, that will be taxed where the permanent establishment is situated. And Article 13.3 is a special rule on the gain from selling ships, aircraft operating in international traffic, or boats operating in inland waterways activities, transport. Yeah, in order to counter behaviors which have been developed in order to circumvent these special rules, there can sometimes even be found an anti-abuse rule. For example, there is currently one, 13.4 mostly, sometimes in some concrete DTTs it's paragraph 2 instead of paragraph 4, but that doesn't really matter. That's an anti-abuse rule in connection with the sale of real estate property. So let's begin at the beginning. The general rule underlines how important it is to determine the country of residence of the taxpayer correctly when you start your testing scheme, because if you go wrong there and end up with the wrong solution, then everything which you do state about the taxation of gains will be completely wrong. Well, covered by that general rule are, for example, the following cases. You sell shares in a company, that's usually only taxable at home in your residence country. So if you trade shares in a foreign stock exchange, and these shares are in, let's say, a French firm, you don't need to fear that you have to pay taxes in France. If there is a clause comparable to Article 13.5, then it's clear the gain from these shares can only be taxed at home in your home country. The same applies to selling rights. So if you sell a patent right or other protected rights, if you sell the claim for the repayment of a credit amount, if you sell monetary claims, if you sell a claim from accounts payable with a gain or a loss, all that only is relevant for your taxation in your state of residence. So, of special importance here is the entry which says, or which applies to the sale of shares in the company, because that allows a trick. That gives you choices. The reason is you can always or nearly always replace ownership of a certain asset by setting up a company or corporation which then buys the asset in question. And then you have two choices. Either you sell, you say the company is going to sell the asset, or you sell the shares in the company. So you sell the company. And now selling, let's say, a piece of land by the company leads to taxation in the country where the piece of land is. But selling the shares under the general rule would be taxable in your home country. And that gives you, in practice, a choice. And the reason is because economically, there is no big difference between owning something yourself, whichever asset it may be, or having a company whose only asset, in the extreme case constellation, whose only asset is that asset, and then selling the shares in that company. So 100% of the shares are equivalent in a company which has 100% of the rights in a certain asset, gives you 100% of the rights in that asset. So that's perfectly equivalent, but the rules are different here, and that is interesting. To show this, imagine here you have the owner. Okay, here you, by the way, can see why I didn't end up as a painter, but as somebody dealing with taxation. But imagine this is now our owner, and the owner has the possibility to buy a house. The owner buys the house, and there is then indeed only one possibility to realize a sale by selling the house. So it would be Article 13.1, where the house is located, there the gain can be taxed. The other alternative construction would be, we have again the house, we have the owner, and now we construct, establish, or however you call it, a company which owns that house. 100% of the house are owned by the company, and the owner owns now 100% or 99.9, must be generous, percent of the shares. Now you have two possible ways how you can realize a sale. You can cause the company to sell the house, make the gain, and later distribute the dividends to you at home. Or you can alternatively sell the shares and then become taxable at home. That works not only with the house, but with any other object too. You can always realize that substitution model. And this naturally brings along a grave problem for the application of Article 13, the special clauses. You can always transform a case constellation into selling shares. So one could always debate if you don't have a choice here. And naturally, having these two alternatives, either to buy or own an asset itself, with the consequence that the gain will be taxed according to the special rule, or setting up a company which then buys the asset and later selling the shares, with the consequence that you pay the taxes from the gain at home in your residence country, that can give you a choice, and that could be treated or regarded as a kind of an abuse. In principle, we have two dangerous points here economically. First, keeping an asset and collecting current income from it, and selling the asset and receiving the price for it are economically the same. They bring the same return. So these two alternative things can be substituted against each other. And so wherever the rules for both are not strictly coordinated, aligned, and identical, also the taxpayer will choose and has a choice and will choose the better outcome. So you have a kind of tax planning potential. Or selling the asset itself, or setting up a company and selling the shares is also two alternatives which are economically equivalent. So if you distinguish between the treatment of both of them, then you give again the taxpayer a choice, and the taxpayer will opt for the best solution. This, however, in turn makes it plausible that the states don't like that and try to create anti-abuse rules. So it makes sense, if we analyze these rules, at least under an economic perspective, to always keep in mind if there are such hidden choices and how the states could should, will react to these choices which they might regard as abusive. Let's begin with the real estate stuff. Article 13.1. If a taxpayer, sorry, if a taxpayer from state A, in the official language, if a state taxpayer from the one contracting state sells real estate property or immovable property as it is called here, situated in state B, or again in the official complicated version, the other contracting state. This gain may be taxed in state B, so may be taxed in the other contracting state. That means gains from selling real estate property are meant to be taxed in the country where the real estate property is located. So the source state has a right to tax, and then your country of residence, you know that Article 23, will have to take back his own claim for taxes, partly or in full, depending on if they grant you the credit or the exemption method under Article 23b or 23a. Well, so this is the basic rule which is meant to take place, and naturally now we have here a very, very easy possibility to use our company construction, which I just outlined a minute before. So that has very often been used, sometimes, by the way, for non-tax reasons. For example, there have been countries where the acquisition of real estate property was forbidden to foreigners, but not to foreign firms, so that foreigners very often and very quickly began to set up local companies, and these local companies then bought real estate property like simple plain houses somewhere in the foreign country. Well, if this model really is used, and it's frequently used, to invest into foreign real estate property, then Article 13.1 is undermined. And so there has already been for a long time an anti-abuse clause in 13.4. The gains from selling shares in a company which owns real estate property in a state are taxable in that state where the property is located. So deviating from 13.5, the selling of the shares can be taxed in the source state of the real estate property. If the value of the shares depends to more than 50% traditionally from the immovable property in that state. So let's say if we have that most extreme constellation, that there is a house somewhere in, let's say, Cheshire, and there is a company which has only one asset, that house, then selling 100% of the shares becomes taxable in Cheshire because, or in the Czech Republic, because, well, it's just regarded as circumvention of Article 13.1. Now, naturally, if you just add a small additional asset to the house, let's say if there is a house and then there are two books in the possession of the company, that doesn't change anything. So that explains why one has to say a minimum percentage of the property or of the assets of the company must consist of other property, or the idea is if still more than 50% of the value of the company are represented by that house or building or piece of land, then this is still potentially a circumvention of Article 13.1, and so we give the right to tax the shares to the country where the immovable property is located. Potential difficulties here are the company doesn't need to be a company of the state where the house is located. That's clear, so it can be from any state, even from a third state. It doesn't matter. Then but that could make the solution of such a case more complicated. Then, far more dangerous or far more a source of complications. It might be that a company has real estate property in more than one state. Let's say they have a house of 500,000 in state 1. They have a house of 500,000 in state B, and they have a house of 500,000 in state C. And now they have debts of 1.4 million. That would lead to a net property of the company of 100,000 euro. Okay? And now, if you now make the test, if the real estate property in state A is equivalent to more than 50% of the value of the shares, which can only be based on the net property, then you get the clear outcome: value of the shares 100,000, value of the house 500,000. State A then can invoke Article 13.4. State B can do the same. The house there is 500,000. The net value of the shares is 100,000. So they are far beyond that 50% threshold. And you have also State C claiming right to tax the gain from the shares. Oh, yeah, so that's bad. On the other hand, you could, if you have no liabilities at all in play, then you could easily circumvent the whole thing by just setting up one company which then owns houses in 3 states. House in state A, 500,000, house in state B, 500,000, house in state C, 500,000, total amount of value 1.5 million, no house in one of the states each equals 50% at least of the total value of the company. So you could sell the shares and pay taxes only at home. Although one must necessarily see that in that case you oblige yourself to sell economically, to sell these 3 houses only as a block. You can't then sell them individually. So that restricts the possibilities to circumvent the taxation rights of one state at least a bit. So this is the traditional clause, and you have already heard that there has been the multilateral instrument, that treaty between many states to override all the existing double taxation treaties. And here they had an Article 9 in the MLI, which then says there are existing double taxation treaties which do not yet contain an Article 13.4. That gap must be filled. And then there might also be possibilities for abuse to get rid of that 50%, for example, by manipulation of the property situation of the company. One might, for example, think about the following constellation. You have such a company in a state which has only one building, 500,000. It has no liabilities and nothing else. So 100% of the value of the shares relies on the value of the house. Now you want to sell that house, and what you now do is, shortly before you sell to a potential buyer, you just push in another 1.5 million in cash or shares in which are traded in the stock exchange or so. You just push up the property of that company by 1.5 other properties, 1.5 million. Now you have 2 million total property. And now you sell that company, which basically then consists of the house plus 1.5 million cash or cash equivalents. The buyer will be willing now to pay 2 million. And the first thing the buyer afterwards does is to withdraw in form of a dividend or a partial reduction of the paid-in capital to reduce the value again to 500,000 just by taking out the cash and cash equivalents from the company again. So that trick was also so easy that the MLI writers said we need to block that. So they said it does not only trigger the Article 13.4 abuse clause, anti-abuse clause, if you sell a company whose value consists of more than 50% a certain or real estate in a certain given state, but also if that relation was fulfilled or that percentage was reached at a single day during the last 365 days before the sale. The idea here is at least such short-term manipulations are then excluded. Things like you find a potential buyer in January for the house of 500,000. Buyer says, I'm interested in buying your house. You say, okay, this house is organized as a corporation. I'm going to sell you the shares, but I want to avoid the taxes in the source country, so allow me to push up the property of that company by 1.5 million in cash and cash equivalents before, and then I do that in February, and in March we meet and we sign a notary contract that you buy my shares now for their now value of 2 million, and so I only pay taxes in my home country. Here at least you are forced to do this in a time distance of practically 1 year in advance, which reduces this possibility to use that abuse model, at least to long-term prepared arrangements. Because if you now want to trigger Article 13.4 or to avoid it, you need a time of 365 days before selling. Interesting, by the way, is that they didn't write 1 year. It's not fully clear if that 365 days was chosen because a year would not have been so precise. For example, that a year could have meant the tax assessment period, the calendar year, or indeed a period of 1 year before the sale occurred, and so on. Now, naturally, that extension of the period during which you check these 50% threshold makes it possible that in practice, if you have a 3 or 4 state constellation, more than one state claims that 13.4 is applicable. So, for example, if you have a 3-country constellation and you have a house in state A, 500,000, a company owns that, and now, let's say 2 months later, that company also buys a house in state B for, let's say, 1 million. Then you have in the first days in the 365 days period, country A fulfilling the 50% threshold because there is only that house in state A with a value of 500,000 and no other asset. Later, the house in state B comes on top with 1 million, that's more than 50%. So also under the treaty with state B could claim the right to tax the sale gain from the shares. So more than one state alone could claim that right. And so in the end, you would probably have a taxation of the gain from the sales in state A under the treaty with the residence country, in state B under the treaty with residence country, and last but not least in the country of residence of the taxpayer under both treaties. So you would have 3 times a tax on the sale on the gain from the shares, and that can bring along difficulties in practice, naturally. Yeah, further difficulties can be brought along if it's not an abusive constellation. Because if you are, let's say, a minority shareholder in such a company, you will probably not have a possibility to obtain the necessary information to declare your tax declaration correctly. Imagine, for example, the events which I just outlined now, that a company has one house in state A, later buys a second house in state B, and you only have 5 or 10% as a shareholder, then it's sometimes not plausible that you will be able to get the necessary information to hand in a correct tax declaration. That's a problem. On the other hand, if the states renounced on that and would apply 13.4 not to minority shareholders, then it could easily be done that a kind of a fund is set up and 10 people unite, set up a company, buy a single house, and later sell the shares in the company in order to circumvent the taxation rights of the country where the house is located. So problems over problems. In real life, one can probably only recommend that you only buy shares in companies where you can be absolutely or reasonably be sure that they do not hold major real estate property. Otherwise, there might be difficulties. There is even a further effect. The Article 13.4 gives the right to tax the gain from selling the shares completely. So also for that part of the gain which refers to other assets held by the company, the right to tax the gain from selling the shares is given completely to the country where the real estate property is located. So imagine if the country of residence were to react by exemption method, this would also become a means of potential manipulation to change the country which can tax your gain from selling shares to the source country of the real estate property. Would probably in certain constellations be advantageous, so would give rise to tax planning. This would not be possible if the state of residence reacts in such cases only by application of the credit method, and this can in all probabilities then be expected in most cases where such a clause applies. Yeah. Last but not least, let me give you a short overview about how current income from immovable property is taxed. Income from a house, a piece of land, and so on will be or can be taxed in the country where that house or so is situated. So the source country gets a right to tax. What the residence country is going to do is then defined as you know it in Article 23, so either exemption or credit method. An additional remark is necessary. Income from immovable property is also income from agriculture, forestry, a farm, and so on, because all that is regarded as income from land. So Article 6 also refers to farming property and so. And as a consequence of this, also selling a farm or selling a forest or so would be treated under Article 13.1 and 13.4. Just to illustrate how things would work, let's imagine taxpayer F from Frankfurt has a house in France from which he gets a rent of 20,000. Then F is resident in Germany, 4.1. France may levy a tax, 6.1, and the German reaction would be Germany applies the exemption method, so no tax in Germany. G from Great Britain has a house in Frankfurt from which he gets a rent of 20,000. F is resident in GB, so taxpayer of GB. Germany may levy a tax as source country. GB reacts by Article 23b, so England gives the credit method. That would be the simple way how it can be construed. So let's now turn over to the next kind of property which you can sell. That is now the movable property of a permanent establishment. Under Article 13.2, this is regulated. The gains from the alienation of movable property go to that country or can be taxed by the country where the permanent establishment is situated. It's restricted to the movable property because the immovable property of a PE of a permanent establishment, that is already dealt with under 13.1, as you have just heard. 13.2 just gives the right to tax the gain from a sale of a movable asset to the state where the permanent establishment is located, irrespective of the question whether you sell a single asset alone or the complete permanent establishment as a whole. Here again, we could think about circumvening that rule by replacing the permanent establishment and its assets by a company which holds now these assets, and then you sell just the shares in the company. So you have here in 13.2 the same hidden choice as in 13.1, but up to now at least there is not a single anti-abuse rule which I know in the double taxation treaties. That seems to be, based on the fact that you have many non-tax related differences between a permanent establishment in a country and a subsidiary local company there. So probably the tax authorities think that's not interchangeable enough. There is no risk for an abuse. Even more plausible is perhaps the idea that the tax authorities regard setting up a company in a country as the, let's say, natural kind of behavior, so that setting up a company in order to circumvene the possibility that a PE has to pay taxes on selling assets, that setting up a company as an abuse is for them not a viable idea, so that they just think this is the natural behavior. If somebody does this, this is not an abuse, this is normal. So that could explain why we don't have an anti-abuse rule here. One could also analyze the economic situation and probably bring forward that if you want to avoid the sale, if you want to avoid to have to pay taxes on the gain from sale of an asset sold by a PE, that then changing the PE into a company does not bring very much, because a rational buyer's behavior has a certain influence on the price of the shares, and a rational buyer will always take into account indirectly in the valuation of the shares the corporation tax burden or the tax burden which is to be expected on the hidden reserves. For example, if you imagine that a PE has assets with a book value of €1 and a market value of €1,000,000, then the correct value for the shares in such a company is not 1 million, but it is 1 million minus the corporation tax on the hidden reserves, because more than that can never be distributed as dividends or liquidation amounts from that company. So if the corporation tax there were 40%, it's clear that if you have a market value of 1 million there, in that situation, if you sell that asset by a corporation, you will never be able to distribute more than 600,000 to the shareholders, or to obtain a price of more than 600,000 for the shares because of that. So if the value of the shares gets correctly determined, there could be no incentive for an abusive replacement of a PE by a subsidiary. However, surprisingly, the same economic logic should in principle also apply to the first constellation, 13.1, pieces of land. But in that context, that seems not to be as a convincing argument against abusive behavior in such a case. Probably the difference is that pieces of land or houses could be kept unsold for eternity, so that the hidden reserves in the house would never be realized, so that the state never gets its taxes on the company level. That might be an explanation. Or it might be that people in real life just value the shares in such a company wrongly, because they might be willing to pay the complete market value of that house or so for the shares, which would be economically wrong. One never knows. Yeah, how current income from a permanent establishment is taxed will be dealt with in Article 7 OECD Model Convention, and we are going to talk about this article later. The same applies to the question what is regarded as a permanent establishment in the double taxation treaties and what problems arise from that. That's Article 5. The last thing which we have to mention shortly as a special rule in Article 13 gains is gains from selling ships or aircrafts operating in international traffic, or boats, not boats, sorry, boats engaged in inland waterways transport, including the movable property which belongs to such ships, aircraft, or boats. That will be taxable only, and only is here an important word because it precludes the application of Articles 23a or 23b. It shall be taxable only in the state where the effective management of the enterprise is located. This rule corresponds with the rule how current income from such activities is taxed. Well, the comparable rule is to be found in Article 8.1 and 2 of the OECD Model Convention, and so there seems to be no big incentive to replace current income by gains from alienation and vice versa, at first glance at least. By the way, the reason for that rule with the place of management is if you look for the location or place of registration of the ships, all that can be permanently changing, or the registration place can be arbitrarily manipulated or chosen. So the place of management is the thing which is probably connected with real life in the best possible way. However, if we check the possibility to replace ownership of a ship by setting up a company which then owns the ship in international transport, then if the company sells the ship, the place of management of the ship counts. If you sell the shares in such a company, then you will pay for the gain in the country where you as a shareholder are resident. So here that model would give us again possibilities for manipulation, although the OECD has not taken any steps, neither in the OECD Model Convention nor in the MLI, to do something against such potential choices. That seems to show us that evidently in real life nobody makes use of that tax saving opportunity until now. Okay, that shall be enough for Article 13. This is the end for today. Thank you for watching and hope to see you soon when we talk about additional further articles. Thanks and goodbye.